If you enjoyed this podcast, please subscribe, like, and share so we can find others like yourself. BitcoinProsperityPodcast.com. Welcome to the Bitcoin Prosperity Podcast with your host Gordon, that's me, and Ferris from CoinCompass.com, enabling you to safely buy and securely store your Bitcoins. All resources are in the show notes and description, including our full disclaimer. Visit BitcoinProsperityPodcast.com to subscribe and discover other free content.
Good morning, everyone, and welcome to another Bitcoin Prosperity Podcast. We are doing a roundup of Bitcoin and markets. Thank you for joining us. It is April the 13th, and today, let's start off with, obviously, what's still going on in the world. We've got this global pandemic, so I am not going to go into detail of the virus because simply I am not a biomolecular scientist on any level, and I just recommend everyone just look after yourselves, look after your family. A good website to go to is peakprosperity.com, not affiliated with us. My sympathies and empathies go out to the people that have been affected by this, and my respect and admiration to everyone in healthcare workers. And at the risk of just sounding disconnected, we're not. Our role here is just to talk about Bitcoin and markets, and we are very fortunate to be able to still be doing so, considering what a lot of people are going through. So with that in mind, big picture is economically, the wheels unfortunately have stopped spinning. Since 2000 and 2008, central bank policies, especially in the US, China, European countries, has been to essentially try to get the economies moving by providing cheap credit. So in essence, we wanted to stimulate the economy not through growth, not through organic growth, but by giving people cheap money to buy things. So it's literally the hamster in the wheel, and that wheel has stopped spinning and hamster's got nowhere to go. This has been the worst possible scenario for central bank policies. A system that was encouraging people to go out and spend, people literally cannot go out to spend. So I don't see how this is going to get any better, and we'll talk about this in more detail later. Slide 3. We're going to whip around the markets. First one I want to look at is a Wilshire 4500. So it's called a Wilshire 4500 because it's the aggregate of 4,500 listed companies in the world globally. It used to be called the Wilshire 5000, but it's knocked off 10% because they found they didn't have 5,000 companies to put in there. Essentially, we've had fewer and fewer companies getting listed. Part of that is essentially monopolies taking over and buying out smaller companies, Amazon, for example. So if we look at a chart of 4,500 Wilshire, so if you look at the orange line at the very top there, that's sitting at 1626. So that was a high that we reached in late 2018. We took another year to get to that point, but we didn't actually reach that point. We got just below it. And then what we've seen is we've now hit lower lows. So we had the late 2018 correction, and then we've had another bigger correction that went even further. Now, this week is going to be the telltale sign for markets. So if you look at this, you can see we're hitting this green dotted line, which was around about the bottom of the 2018. And then that's where it rebounded from that point. This is a monthly chart that we're looking at. So each candle represents a month. So we then went up, but we didn't hit all-time highs again. So if we continue to go up from here, then yes, potentially we'd be looking at revisiting these highs. I really see us struggling to break through. Unfortunately, the most likely scenario is we retest these lows at 850. We didn't quite get there recently. We got very close. If we break 850, then we're looking at revisiting 525. So you're talking from 1200 to 525. That is more than a 50% drop globally on global markets. And this isn't just a case with this Wilshire 4500. The other ones we wanted to look at we'll go to US, the S&P 500 and the NASDAQ. So the S&P 500 Same thing. We reached highs of 3,400. We've retested lower lows again. So if we look here, this is echoing what we were just looking at before. So we breached the lows of 2018, and we've gone even lower to 2,200. The next level of support, if you're a swing trader, is all the way down here at 1,800. If we break 1,800, we go through that, we are going all the way down to, I believe, this green dotted line here of 1,100. So you're talking from 3,400 down to 1,100. Now, you might think that's impossible. However, if we zoom out a little bit, and if we go to 2000, this was a .com top. And when the .com top corrected, it went down to this green dotted line here of 800. So from 1,500, 50% correction pretty much, down to below 800. Those lows in 2003, we went lower in 2008. So when we think that, oh no, we can't possibly revisit these lows, well, we've done that before and gotten lower. So technically, there's no reason we can't even revisit the 2008 lows, 2009 lows. Apologies. So that's what we're looking at. And this run has just been monumental. And this is in all global markets. It's just a roller coaster. And, they say you can't fight gravity. So the NASDAQ is even, worse, if you want to look at it that way. And we've posted this before. So if you take the highs of the .com bubble that was in, 2000, it took 15 years to regain those highs. 15 years to get back to those highs. And in the period, we had a global financial crisis. So there's no reason we can retest below 5,000 from where we are today. So that is, again, a 50% correction as to where we are. The DAX is another one I'm looking at. So this is in Germany. So what's actually benefiting the DAX is the euro has been dropping. And that benefits in indices because their earnings in the future are basically coming strong because it's a currency it's a currency swap. They haven't sold more products, but because their currency is cheaper, when they sell those products and bring their profits home from overseas, it just adds to their balance sheet. So the DAX is at another critical level as well. This green dotted line above 8,000. We break that. The next level that we're going to test is 5,000. So again, we're looking at 50% levels from where we are today if we break this green dotted line here of 8,000. Now, lastly is a Nikkei as an indice. Nikkei is in Japan and very similar. I don't trade the Nikkei. It's just incredibly volatile. But yeah, similar things here. So we've got a level of support at 1,500. It is currently just below 20,000. So 25% drop potentially to 1,500. Below that, you are looking significantly lower. What the Nikkei's got going for it, technically, is that it hasn't had that exuberance that we've seen in European and American indices. You can see this is kind of been in a range for a while. It hasn't just skyrocketed like the other indices we were looking at. All right, the US dollar. So the US dollar was in this upward channel from late 2018 all the way to late 2019. It broke through that upward channel, but broke above it. So that is incredible volatility for basically the world reserve currency. And we are at this point where intellectually people are arguing that the dollar is going to go higher because commodities are based on the dollar. There's a global US dollar shortage. At times like these, it's a flight to safety. And there are people who are saying that, no, it's the end of the global reserve currency. And we're seeing the end of the petrodollar. So like all other currencies before it, the pound, the Portuguese and Spanish real, all global reserve currencies eventually come to an end. So again, very important times. Is this the beginning is this the end of the US dollar, or are we going to see one more squeeze higher? These next few weeks are telltale signs. Oil. So this is very interesting for oil. So the blue line on this big chart here is a monthly chart. Blue line is where we're at. The last time oil was this low was 2002, almost 20 years ago. That's incredible. And the orange line at $20 is your next level of support. And there's talk of $10 oil. Now, the reason they're talking $10 oil was that's the lows it got in 98, sorry. And it's a big round number. That's why they're using $10 oil. I would see that as a pretty good buying opportunity at $10, just on a speculative position. But yeah, this does not bode well for global economies. When oil is down, it's basically saying people aren't traveling, people aren't spending, because it's not just in airplane fuel and car fuels that you have oil. It's in everything. It's in your plastic bags. It's in your products. It's everywhere. It's still such a key part of a global economy. Electric cars will not bring an end to oil. It's everywhere. So yeah, when you look at this chart of oil, we had this breakout of this wedge in 2011, 2015. And it just dropped. Again, lost 50%. And this is in a time that central banks are saying we're in a global economic recovery. That does not look like a global economic recovery. Global economic recovery implies we need oil to create products. We need oil to ship those products. We need oil for cars to transport those products. That does not look like a global economic recovery to me, just looking at the price of oil.
Do you want to learn how to safely buy and securely store your Bitcoins? CoinCompass.com is running a free 2-hour webinar on Sunday, 31st of May. To register and for more details, visit CoinCompass.com/webinar.
So the Fed balance sheet, so in essence, this is federal debt. So this is a U.S. Fed balance sheet. So you can see here in 2008, they basically doubled in 2 months. They doubled what they were buying. So the Federal Reserve was buying assets to basically, prevent the world from collapsing. That has gone up nonstop since. And we've just seen overnight, in 2 weeks, apologies, it'd be 3 weeks. We've doubled again. So not doubled again, but almost doubled again, from $4 trillion to $6 trillion. So the Fed is just throwing more and more money at this problem. And as we alluded to earlier, they're hoping that debt is a solution to more debt, which anyone who knows what Einstein said, the definition of insanity is trying the same things and expecting different results. I want to focus on the USA. So I want to look, this is an annual chart of the S&P 500. So an annual meaning that every bar you're looking at is reflecting 1 year. So each candle here is a year. And this template that I'm putting over here is a tone, I call it a tone vase indicator. So this, anyone who follows Bitcoin would actually know who Tone Vase is. He was a former vice president at JP Morgan and really just follows Bitcoin, but has been very, has made some very good calls, not just with Bitcoin, but with the stock market. And I haven't seen him for a while. But we're looking at, he follows these 9 indicators based on the Tom DeMark indicators, but he's tweeted them himself. And we're looking at a global 9, which is a reversal candle, essentially, or a pause. So this basically is saying that, yep, we've reached a point of exuberance. We are looking for this to trend sideways or to go lower. If it goes higher, it's going higher for another 9 count. So what this is saying is essentially you see that sign, you're going, okay, just go to cash. Wait to see what happens. Are we going higher, sideways, or lower? This is a point where it says we've run out of steam. Slow it down. And as you can see, it's not completely accurate. We've got 2 9s back here, and they're already beginning a new bull run. So if we see this again, we have a green 2 here. That's basically saying, yep, get back into this market. And then we had this pause here, but this is a huge run up 8. So if this year finishes in black 9, we are looking at potentially a 4-year down count. So 4-year of just the market's going down, potentially. But all this is saying is best thing to do right now is not to trade. So bonds. So this is a 3-year chart on bonds. So this is yield. So if the yield is going down, the coupon is going down, it means that bond prices themselves are going up. So as you can see, this yield is going down and means bond prices are going up. This is a 30-year bond yield. So the interest went from 3.5%. So if you bought bonds at 3.5%, you're now earning 1.3%. And I mean, that just completely dropped. Now, if we zoom out, so what this means is there's a demand for bonds. If people are buying bonds, it's seen as a safe haven, non-risky asset. So it doesn't bode well for the economy when bonds are in demand. If we zoom out, I'm actually going to change this to a yearly chart. So this was a weekly. Let's go to a yearly chart. Apologies. We'll make it monthly. So this is the chart we're just looking at, but monthly. And this goes back from 1988. And you can just see this downward channel in bonds. So essentially what happened was in the 70s, we had inflation. And then we had Paul Volcker deliberately tackling inflation. Baby boomers remember putting money in the bank and getting 15, 17% interest. This means that interest rate has been going down. So the interest rate went down from 10%, and we even dropped below 1% on the US 30-year. So people were saying, can't possibly get any lower. Well, it can. And if you look at the end of this channel, it's hitting 0. Not only have we hit 0 in Europe, we've hit negative in Europe. We've gone below 0, which is absurd. You're giving the government your money, and they're going to give you back less. And that's, All right, so safe haven assets. We've just talked about bonds. So let's look at gold. Now, gold was in this, you see this big blue box here. Gold was basically in a really long 7-year trend going sideways. Now that is a huge base. And what happens here is if it breaks out of the base or breaks below the base, that is going to be a long-term trend. So this base, the longer it is, the bigger the breakout or breakdown. So this base is basically saying we don't know if gold is going to go above 1400 or if it's going to go below 1050. And that was the range for 7 years. So traders in gold basically just kind of up and down, not knowing where it's going to go. Well, we've broken out well and truly. We came back, and normally what you'd do is you'd see this breakout of the base. You'd want it to come back and test the top of this base, 1400. And quite a few people were expecting it to come back and test 1400. We didn't get that low. We got to 1440 twice. So very bullish for gold. And if you're bullish for gold, you're basically saying you do not have trust in central banks and global economic policies. And if you look back here at this area here of 2008 to 2009, you're essentially seeing a similar thing. I'll just highlight this area. So here we had gold trending down, and that was only for about a year or 2 years. It sold off, and that was the last financial crisis. And gold just skyrocketed to 1900. So we've now had this whole holding period where gold's basically gone sideways. So I am expecting gold to break all-time highs. US dollar, we mentioned already. The Japanese yen and euro, we're not going to go into in detail. That is part of the DXY that we looked at before. So let's move on to Bitcoin. Oh, no, before we do, I do want to go back. There was a chart here from Peter Brandt. So Peter Brandt, I saw this tweet and I was very tempted to trade off this tweet alone, which obviously is not proper due diligence. If I'm going to trade, I want to do so under my own initiative, under my own analysis. Peter Brandt I respect very, very much as a trader, probably more so than anyone else out there at the moment. And he basically tweeted that we are looking at a potential head and shoulders in the S&P 500. And on Friday, he actually went short. And I think, well, with the news that's come out over the weekend of April 14, 15 weekend, we are potentially looking at a gap down in markets as we open this morning on the 16th, which means his shorts paid off. So, yeah, so we've got these reasons to basically think, yeah, indices have topped here and we are looking at a rollover. All right, on to Bitcoin. How does Bitcoin fit into all of this? So we believe that Bitcoin is a safe haven asset, but it doesn't matter what we believe, it's what the market believes. And the market, it was not treating Bitcoin like a safe haven asset because Bitcoin was basically being correlated to what the S&P 500 was doing. And I'll give you an example, and we have spoken about this before. If we want to compare the price of Bitcoin to the S&P 500, all right, so the S&P 500, I'll make it this line here. All right, so, and you can see, look at that correlation. As S&P 500 went up, as Bitcoin went up, the S&P 500 followed. So if anything, Bitcoin has actually been an indicator to the S&P 500. Sorry, I'm looking at the wrong thing here. Can you just scrap what I just said, guys? That is the moving average, which I will hide. There it is. Okay. Yeah, so this actually, if you look at this, the orange line here is the S&P 500. And there is a very strong correlation there between the S&P 500 and Bitcoin. And if the S&P 500 starts to roll over, you expect Bitcoin to do the same based on these correlations. All correlations will break at some point, but Bitcoin has been trading like a speculative investment, not like a safe haven asset. So that correlation since 2017 is quite striking. And it makes me pretty nervous, actually, for the price for Bitcoin. So where are we now? I actually, a week ago, when Bitcoin broke above 7,200, was expecting it to go higher. And I just personally believe 7,200 at this stage is a key level. So 7,200 for Bitcoin, I think, is a key level. I think we need to really just convincingly break above 7,200 here. I want to say hold above that. Really just hold above 7,200 to see Bitcoin start moving up. If we roll over here, then potentially we're revisiting these lows of 3,100. If we break 3,100, guys, we are looking back at around 1,800. So these next week to two weeks or 30 days are vital, not just for Bitcoin, but for all global markets. Are we heading lower? Or like in the past, is this liquidity, just money printing by federal governments, essentially going to work? When I say work, increase asset prices. It hasn't really helped the middle class. We've seen a decimation of the middle class. So are we going to see asset prices increase in value, or are they going to continue to go down? So this week especially, I think will be very, very indicative of what's going to happen. So yeah, are we looking at the end of exuberance? We've got on a yearly chart, we've got the S&P 500 at the 9 indicator, Peter Brandt, we saw where he was. The Fed balance sheet just printing money. So at this stage, we are just waiting for something to happen. And the only thing we can do is look after yourselves, look after your health, look after your loved ones. And with Bitcoin, I know you want me to go into more detail here, but I'm apprehensive about the price of Bitcoin. I cannot be more excited about the macro fundamentals for Bitcoin. When you look at money printing, central banks basically doing whatever the hell they want and getting away with it, the economic backdrop for Bitcoin, the fundamental backdrop for Bitcoin cannot be more promising for Bitcoin. However, as I said, it does not matter what I believe. It only matters what the markets believe. So, and yeah, we've got this, decent downtrend here for Bitcoin as well. This downtrend line that I've just done in green. So I am very positive about Bitcoin. I do believe in Bitcoin. I am a firm believer. There's potential more upside. If we hit this trend line, though, we could go lower, and that trend line's at 9,500. So there's still a lot of overhead resistance for Bitcoin. I don't see everyday investors rushing out to buy Bitcoin when they're losing work. They can't leave their homes. People are, unemployment rate is skyrocketing. So we are in dire times, very dire times. And unfortunately, only thing we need to do, from my understanding, is lock down economies, stop this virus from spreading. So, that is our Bitcoin and markets roundup. Is just waiting right now. If you are an investor, if you are a trader, cash is a place to be. You would want to hold long-term things like gold. Bitcoin, I still believe holding long-term. Maybe you might get a cheaper price to get into Bitcoin, maybe not. So, as you know, our opinion here at Coin Compass is essentially just dollar cost averaging, which basically means you just buy what you're willing to lose and don't focus too much on the price, but just get in. So, thank you, everyone, and please listen to our disclaimer. This is not financial advice. These are just opinions. And we really appreciate you listening in, and please be safe.
Thanks for watching or listening. Please visit coincompass.com/free to register to our socials and discover other free content. Subscribing, liking, and following helps this content remain ad-free. Until next time.